Good afternoon. My name is Nathan. It is my pleasure to welcome you to the RegTech Association's RegTech Matters program. Today, we have a special presentation from AUSTRAC on the Australian anti-money laundering and counter-terrorism financing reforms. In a spirit of reconciliation, the RegTech Association acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community. We pay our respect to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islanders people today. In acknowledging country, we honour the resilience, wisdom and innovative spirit of Indigenous communities. I'm now delighted to welcome to the virtual stage our AUSTRAC speakers for today, Hilary Randall and Isabella Anderson. Hilary is the Acting Director of AUSTRAC's Industry, Education and Outreach team, where she supports regulated entities, industry bodies, government and other partners through the provision of education and guidance on Australia's anti-money laundering and counter-terrorism financing regime and financial crime risks. Hilary has over 7 years of experience working at AUSTRAC across reform, regulatory operations and education and guidance. And Isabella is an Acting Manager also working in AUSTRAC's Industry, Education and Outreach team, where she works with a team of staff to educate regulated entities and industry bodies on the obligations under the AML CTF Act, including the recent reformations to the law. She has 10 years of experience in communications and has been with AUSTRAC for 2 years now, working across regulation and intelligence products. Thank you to you both. I'll hand the floor over to you.
Thank you so much, Nathan. While Isabella is loading up the slides, I'll just say good afternoon to everyone and thank you very much for joining us for this RegTech Matters session. A big thank you also to Nathan for inviting us to speak today. So as Nathan said, my name's Hilary and with me is Isabella and we're from AUSTRAC's Industry, Education and Outreach team. So today we're going to provide an update on the anti-money laundering and counter-terrorism financing or AML CTF reforms. We'll run you through some of the new and changed obligations which are likely to impact the RegTech sector. We'll then talk about how you can ensure that your solutions remain effective, and we'll cover AUSTRAC's expectations for reform implementation and how you can prepare your solutions now. Now, Isabella and I will be speaking about the reforms at a very high level, and this is because the core guidance is still going through consultation. So the guidance will be published in October this year, and we'll explain each of these obligations in much further detail. So firstly, we'll take a quick look at what the reforms are. So in November last year, the Parliament of Australia passed a bill to amend the AML CTF Act to simplify and modernise the AML CTF regime. These amendments will also bring the Australian regime in line with international standards set by the Financial Action Task Force, or FATF, which is the global financial crime watchdog and standard setter. The new AML CTF rules, which were just recently published in August, provide further details on the obligations under the new Act. So from the 31st of March next year, the reformed laws will come into effect for the businesses that we currently regulate. Then, from the 1st of July next year, new services and entities, which we commonly refer to as Tranche 2, will also come under AUSTRAC regulation. So if you're not aware, Tranche 2 includes some high-risk and non-financial business providers. So this is real estate professionals, dealers in precious metals and stones. It covers lawyers, conveyancers, accountants, and trust and company service providers. Right now, there are gaps in our financial systems defences when it comes to money laundering, terrorism financing, and proliferation financing. So the changes to the AML CTF Act, rules and regime will help us to address these gaps and build a stronger and more proactive intelligence picture. The goal of these reforms is really quite simple: close those avenues to organised crime. Now, some of you here today may be looking to provide services to Tranche 2 entities, so it's really important to understand their risk exposure and some of the indicators of their businesses being exploited by criminals. So on the next few slides, I'll take you through some high-level examples as these can inform your solutions for customer or enterprise risk assessments, as well as transaction and customer monitoring. So we'll start with the real estate sector. Some indicators to be aware of in this sector include the use of complex ownership structures, where criminals employ complex legal structures like shell companies, trusts, and this is to obscure the true ownership of properties, making it challenging to trace illicit funds. Then we have the rapid resale of properties. So quick turnovers of real estate, especially at prices that are inconsistent with market values, and this can indicate attempts to launder money through property transactions. Next, there are transactions involving high-risk countries. This includes engaging in property deals with parties from countries known for high corruption or weak AML CTF controls. And finally, in this sector, we have the use of unusual payment methods. These are payments made in cash or through third parties without clear economic rationale. Transactions like this may suggest money laundering activities. In the accounting sector, some indicators of criminal activity include high net worth individuals who have more complex business and financial arrangements. So this might include offshore accounts or trusts. Next, we have unusual financial transactions. This might mean transactions that are inconsistent with a customer's known business activities or financial profile, and this can be indicative of illicit activities. There's also the use of customer accounts for third-party transactions. This is when customer accounts are used to process funds unrelated to the customer's business, which can suggest money laundering or other suspicious activity. Then we have reluctance to provide information. Customers who are unwilling to provide necessary information or documentation can pose a higher risk for money laundering and terrorism financing. And finally, in this sector, be aware of frequent changes in business structures. So regular alterations in company ownership or structure without a clear rationale. These may be attempts to obscure financial trails. Moving on to the legal sector, we have involvement in high-value transactions without clear legal purpose. This might look like facilitating large financial transactions that lack a legitimate legal basis and can be a red flag. Another example is limited face-to-face interactions. For example, customers who only engage with reporting entities online and not in person. You should also be aware of customers who change professional advisors often without legitimate reasons, or who have been refused service by other professional advisors. Next, we have transactions involving high-risk countries. An example of this might be customers that have links to fraud, bribery, corruption, or high-risk countries. And lastly, customers seeking anonymity, where customers insist on confidentiality or they resist to disclose certain information. This can be an indicator they may be attempting to hide illicit activities. Now, the final sector we'll go through is dealers in precious metals and stones. Indicators in this sector could be frequent purchases of high-value items, so regular purchases of expensive metals or stones without a clear business or investment rationale. This might indicate money laundering and terrorism financing activities. Secondly, large cash transactions. Payments involving significant amounts of cash may be attempts to launder money. Then we have unusual activity. So things like customers frequently changing their bank details, their address, their business name or point of contact, or even intermediaries between transactions. You should also be alert to the use of third parties for purchases. This is when buyers use intermediaries to conduct transactions in an attempt to obscure the true beneficiary. And finally, there's exporting goods to high-risk countries. Shipping precious metals or stones to countries that are known for weak AML CTF controls can be part of trade-based money laundering schemes. So if you do intend to provide solutions for any of these tranche 2 sectors, do make yourself aware of these risks and indicators. More information can also be found in the national risk assessments that AUSTRAC published recently, and further risk insights for each of these sectors is going to be released with the guidance in October this year. Now, we recognise that third-party providers like RegTech play an important role in assisting reporting entities to meet their obligation, and that the solutions you offer may be impacted by some of the changes to the AML CTF regime. So the key changes that we need you to be aware of include both new obligations as well as changes to the existing obligations. Some new obligations that we'll discuss today include the travel rule and the obligation to assess and manage proliferation financing risk. And then we'll discuss some of the obligations that are changing. So this includes customer due diligence and personnel due diligence. Now, before we get into those, some of you may be aware that the reforms also include changes to the reportable details or information that has to be provided in threshold transaction and suspicious matter reports, or TTRs and SMRs. Now, fundamentally, the types of information required to be included in these reports remain similar. Essentially, the current rules were reviewed and updated to better align them with the language and concepts in the reformed regime. So, for example, the new CDD obligations, which we'll speak about later. The reportable details have also been revised with the new designated services, as well as advancements in technology and service delivery in mind. So we're really trying to modernise the regime. I do want to flag that the TTR and SMR reporting obligations will remain the same until 2029. So current reporting entities can continue to report on the old reportable details until 2029. So given this, reporting changes won't be a focus for today's session. Today, we'll take a look at some of the relevant new obligations, and we'll start with the travel rule. Some of you who operate internationally might already be familiar with the travel rule, as this is an international standard set by the FATF, which many other jurisdictions already have in place. But for those who aren't familiar with this, under the travel rule, reporting entities that transfer or receive money, virtual assets, or property on behalf of their customers will need to collect, verify, and share specific information with other businesses in the transfer. Now, I'll step this out in more detail over the next few slides. Firstly, we'll take a look at when the travel rule applies. The travel rule applies to businesses that provide the following services: telegraphic transfers or wire transfers, remittances, virtual asset transfers, and gambling service providers or currency exchange businesses who transfer value internationally in connection with their other services. The travel rule directly applies when a business does any of the following: accepts money, property, or virtual assets from a payer to transfer to a payee, transfers funds from a payer's account or receives funds into a payee's account, transfers virtual assets such as cryptocurrency from a payer's account or custodial wallet, or receives virtual assets into a payee's account or custodial wallet, or transfers value associated with owning property from a payer to a payee. So an example of this would be transferring the value of bullion, but not transferring the physical bullion itself. One thing to be aware of with the travel rule is there's no minimum amount for a value transfer. So the travel rule applies to both international and domestic value transfers of any amount. However, if a transfer of value is reasonably incidental to providing another service, then this is generally exempt from the travel rule. So on this next slide, we've got a very basic diagram of a value transfer chain, which is a new concept under the reforms. Now, a value transfer chain refers to the businesses involved in a transfer of value. So it includes the ordering institution, any intermediaries that are involved, and the beneficiary institution. An ordering institution accepts the instruction to transfer value from its customer, who's the payer. If more than one institution is involved in the transfer of value, then the ordering institution passes on a transfer message to the next business in the value chain. An intermediary institution receives and passes on the transfer message, but does not provide the payee with the transferred value. Then a beneficiary institution receives the transfer message and makes the transferred value available to the payee. Now, there can only be one beneficiary institution in a single value transfer, and that beneficiary institution may be the same as the ordering institution if the same institution accepts the instruction and also makes the value available. So, what does this mean for RegTech? If your solution facilitates the transfer of value or facilitates the collection and verification of payer and payee information for transfers, you may need to ensure that you can collect and verify the information that will soon be required. So we'll step you through what's required in the next few slides. The responsibilities that a reporting entity will have for collecting, verifying, and sharing information in a transfer message will depend on their role in that chain that we just talked through. So today, we'll focus a bit more on the ordering institution, but we will be releasing further guidance that details the responsibilities for each institution in the chain. So after receiving a transfer instruction, the ordering institution must collect specific information about the payer. This includes the payer's full name and then one or more of the following: the payer's date and place of birth, the payer's full business or residential address, so no post office boxes, a unique identification number given to the payer by the ordering institution, or a unique identifier for the payer. Once the ordering institution has collected information about the payer to include in the transfer message, they must verify it before completing a value transfer. So as RegTechs, you may need to think about whether your solutions allow for timely verification so that transfers aren't unreasonably delayed. Ordering institutions must also collect the payee's full name and include this in the transfer message. Now, this is unless any of the following circumstances apply. First, if the transfer is passed through bulk electronic clearing system, BPay, or direct electronic funds transfer. Second, if the transfer is a merchant payment or it's a refund of a merchant payment, or if the instruction for the transfer is done using an ATM. One thing to note is that payee information does not need to be verified unless the payee is also a customer of the ordering institution, in which case their information would have already been verified as part of their customer due diligence. So, we've now covered the obligations to collect and verify payee and payer information. The last step for the ordering institution is to share this information. To complete a transfer of value, the ordering institution will need to send a transfer message to the next business in the chain, and this is to share the information that they've collected and verified. The details that they're required to pass on depend on the circumstances of the transfer, but typically this includes the payer information, the payee's full name, tracing information, and a card number if it's for a merchant payment, a refund of a merchant payment, or an ATM withdrawal. Now, I mentioned tracing information. Just in case anyone isn't aware of what that is, tracing information is information that allows the institution to identify where the value is going or where it has been sent from. So this can include things like account numbers, virtual asset wallet addresses, or transaction reference numbers. Now that's everything on the ordering institution. I'll briefly highlight some key responsibilities for the intermediary and beneficiary institutions. Intermediary and beneficiary institutions must take reasonable steps to monitor for missing information in a transfer message. Beneficiary institutions must also take reasonable steps to monitor for inaccurate payee information in a transfer message. So if a transfer message is missing information, the intermediary institution must refuse to send the transfer message to the next business, or they need to take other actions to reduce the risk. So this might be requesting this information from the ordering institution or another intermediary. If a beneficiary institution receives inaccurate information, they may also reject the transfer and decline to make the value available to the payer. So, if you will be providing solutions in this space, you should expect that intermediary and beneficiary institutions may conduct quality assurance on the information that you've provided as part of a value transfer. Now, before I move on, I do want to flag that we will be releasing detailed guidance on the travel rule obligations for ordering intermediary and beneficiary institutions. This is coming out in October, so keep an eye out for this. We'll move on to the second new obligation to be aware of. Now, this is assessing and managing proliferation financing risk. So you may be aware, reporting entities already have the obligation to develop a money laundering and terrorism financing risk assessment to identify and assess the risks of criminals exploiting their business. But the new laws now explicitly state the requirement for reporting entities to identify and assess the risk of proliferation financing or criminals using their businesses to enable the spread of weapons of mass destruction. For anyone here who doesn't know, proliferation financing is when a person makes available an asset, provides a financial service, or conducts a financial transaction that is intended to facilitate the proliferation of weapons of mass destruction. Now, this is regardless of whether the activity occurs or is simply attempted. And in Australia, this activity is prohibited under a range of laws. With the new legislation now requiring reporting entities to assess the risk of proliferation financing, your solutions could help them to monitor for related transactions or identify customers who may pose a higher risk for proliferation financing. If you're not familiar with proliferation financing risks, I'd encourage you to read about the indicators of this activity in our National Risk Assessment of Proliferation Financing in Australia. You can find it on the AUSTRAC website. But for now, I'll give you a bit of a snapshot of what proliferation financing may look like. So some indicators of proliferation financing for customers include using complex company or trust structures and associated banking arrangements, and this is to obscure the source and beneficial ownership of their funds. We have using financial services or conducting transactions that are physically distanced from the actual trade of goods, transferring funds to or from countries of proliferation financing concern, so Iran or North Korea, transferring funds overseas in values similar to recent cash deposits, matching a customer through screening against an Australian or an international sanctions list, and remitting funds to companies linked to countries of proliferation financing. Some indicators of proliferation financing for corporations also include sharing directors and management addresses, emails, phone numbers, and financial infrastructure with other entities in their network, or obscuring their identities and activities. And they can do this in a number of ways. So using aliases and transliteration of company names, using subsidiaries or branches, using third country nationals in corporate ownership structures, or registering in jurisdictions that have opaque corporate registers where information on ultimate beneficial ownership is not easily accessible. Again, the new legislation dictates that reporting entities must identify and assess their proliferation financing risk. So where they are exposed to a risk of this activity, your solutions can really help them in monitoring for proliferation financing transactions or higher risk customers. If you provide risk assessment or customer and transaction monitoring solutions, you should be aware of the proliferation financing risks your clients may be exposed to. So we recommend you engage with your clients on this to get a complete picture of the transactions and activities that they might need to be alerted to. So those are the new obligations that we wanted to take you through. I'll now hand over to Isabella, and she's going to walk us through some of the changed obligations.
Thanks, Hilary, and good afternoon, everyone. So the first change obligation we're going to get into today is customer due diligence, or CDD, which has changed in a fundamental way. I'll unpack this in detail, but essentially we're moving from the prescriptive applicable customer identification procedures to a system that adapts the approach more flexibly to the MLTF risk of a customer. So the CDD measures a reporting entity takes must be appropriate to manage the MLTF risks that customer presents. CDD measures must be, firstly, targeted to the specific MLTF risks of the customer and the services provided to them. Secondly, proportionate to the level of risk. Thirdly, effective at managing and mitigating the MLTF risk posed by a customer. And finally, ongoing if necessary, so the reporting entity can monitor, manage, and mitigate the customer's risk over time. The new legislation sets out an approach of focusing on the outcome to be achieved. Do reporting entities know their customers based on verification using reliable and independent data? To achieve this, under the new laws, there will be 4 distinct kinds of customer due diligence. The first is initial customer due diligence. So this is undertaken before providing a designated service to a customer and is akin to Know Your Customer or KYC. Initial CDD helps a reporting entity to establish if the customer is an individual and take reasonable steps to confirm that the customer is who they claim to be, collect KYC information to determine the risk rating of the customer as being either low, medium, or high. And once the customer's risk rating is determined, to collect further KYC information about the customer as appropriate to their MLTF risk and verify some of the KYC information, again, as appropriate to the risk. The second form of CDD is simplified customer due diligence, which has replaced the concept formerly known as safe harbour. This can be applied to customers that pose a low MLTF risk and don't require enhanced CDD. The third is ongoing customer due diligence. This involves monitoring customers when providing services to appropriately identify, assess, manage, and mitigate MLTF risks over time. Ongoing CDD requires reporting entities to review and update their identification and assessment of the customer's MLTF risk, to monitor for unusual transactions and behaviours, anything that would give rise to a suspicious matter report, and to review, update, and re-verify KYC information. And the final form of CDD is enhanced customer due diligence. So ECDD means applying additional measures when a customer's risk is high to mitigate and manage the risks of higher risk customers. Examples of this include collecting and verifying a greater amount of KYC information, collecting and verifying information on source of wealth and funds, and seeking senior management approval to provide services. So as I've mentioned, when conducting initial CDD, an RE will need to establish a number of things on reasonable grounds before they commence to provide the customer with a designated service. Initial CDD will need to establish the identity of the customer, the identity of any person on whose behalf the customer is receiving a designated service, so i.e. a beneficiary of a trust or foreign equivalent. It'll need to establish the identity of any person acting on behalf of the customer and their authority to act. And it'll need to establish whether any of the aforementioned people or a beneficial owner is a politically exposed person, or PEP, or subject to targeted financial sanctions. So a note here, businesses have actually always had to comply with sanctions law, but now the legislation specifically notes the requirement for REs to screen their customers and ensure they're not subject to targeted financial sanctions. Initial CDD will also need to establish the nature and purpose of the business relationship or occasional transaction with the customer and other matters in certain circumstances. So if an RE cannot establish these matters on reasonable grounds, they must not commence to provide the customer with a designated service. So a takeaway for our reg text in this is that you may need to consider how your solutions can provide timely verification to not delay services. So the next obligation that's changing is personnel due diligence, which was formerly referred to as employee due diligence. Now, while you may not provide solutions in this space, this change may still be impactful for your business. So personnel due diligence involves assessing the skills, knowledge, expertise, and integrity of the people employed or engaged by a reporting entity to perform AML CTF functions. People that fall under the personnel due diligence requirement include contractors and consultants, people employed by the service providers used for AML CTF functions, and non-individuals engaged to perform AML CTF related functions. So this may mean that reporting entities have to conduct due diligence on RegTechs and their staff, depending on your arrangements and how you work with reporting entities. Personnel due diligence helps to protect reporting entities by ensuring that only suitable people perform functions relevant to their AML CTF obligations, and also helps defend against insider threats. Personnel due diligence must be done before an RE employs or engages the third person or third party, and on an ongoing basis during their engagement. So this means that reporting entities may ask RegTechs for specific information about their skills, knowledge, expertise, and integrity in order to meet this due diligence obligation. So now I'll get into what personnel due diligence should assess and what you may be asked for by REs. So reporting entities must assess whether an employee or a third party's employees are suitable before they begin performing AML CTF related functions. They must assess the skill, knowledge, and expertise of the prospective employee in carrying out their responsibilities. So this includes assessing that they understand AML CTF law and obligations, that they have an awareness of MLTF risks associated with their role, that they can apply AML CTF policies effectively, and that they have adequate training or are otherwise competent to receive training to close any knowledge gaps. There are a number of ways an RE can satisfy this requirement, including conducting interviews for the role, completing knowledge-based assessments, considering prior AML CTF qualifications or experience, validating their technical skills or qualifications, checking any professional membership they might hold, checking their website if relevant and any material, video, or updates on it, and seeking evidence of previous performance. So in terms of engaging RegTechs, this could include seeking evidence of how you stay up to date with Australian AML CTF regime and local MLTF risks, seeking evidence of your experience working in AML CTF and with other businesses in their sector, prospective clients asking your other clients about their experience with you, seeking evidence of professional membership, technical skills or qualifications, and prospective clients seeking a demonstration and asking questions about your solution. So REs must also conduct integrity assessments to ensure that personnel uphold ethical standards and don't pose an undue risk to their AML CTF compliance. Assessing integrity may involve verifying their identity, police checks, bankruptcy checks, screening, so for example, sanctions and adverse media, reference checks from previous employers, confirmation of qualifications and certifications, reviewing past regulatory breaches or disciplinary action, and self-disclosures. So there is an obligation for personnel due diligence to be an ongoing practice as risks, roles, and processes evolve in the reporting entity's business. So in the case of working with RegTechs, this may consist of REs requesting to update criminal history checks periodically. So we've talked about a lot. I'll just recap the new and changed obligations we've discussed today. So firstly, Hilary spoke about the travel rule and reporting entities' obligations to collect, verify, share, and ultimately retain records of information on payer and payee information. She also outlined the steps an ordering institution has to take, the differing responsibilities between the ordering, intermediary, and beneficiary institutions, that the intermediary and beneficiary institutions must monitor for missing information in a transfer message, and that beneficiary institutions must monitor for inaccurate payee information in a transfer message. And then secondly, Hilary spoke about proliferation financing risk, and that this must now be considered as part of a standard MLTF risk assessment. So some key things to remember about PF include that risk assessments must assess the risk of proliferation financing, meaning that they must be able to monitor for proliferation financing related transactions. Then I spoke about the changes to customer due diligence, or CDD, and how the reforms have reshaped this obligation from a prescriptive system to a more flexible and risk-based framework. So the key things to remember here include that initial customer due diligence must be completed before providing a designated service to a customer and is similar to current KYC procedures. Initial CDD helps a reporting entity to establish if the customer is an individual and take reasonable steps to confirm that the customer is who they claim to be. Collect KYC information to determine the risk rating of the customer as being either low, medium, or high. And once the customer's risk rating is determined, to collect further KYC information about the customer as appropriate to their MLTF risk, and verify some of the KYC information, again, as appropriate to the risk they pose. And then lastly, I spoke about personnel due diligence and how this has expanded from what was formerly employee due diligence to now include contractors and consultants, people employed by the service providers used for AML CTF functions, and non-individuals engaged to perform AML CTF related functions. So I'll now run through the key takeaways for your industry respective to those changes we discussed. So under the travel rule, any RegTech who offers solutions in relation to value transfer services should ensure that their solution will be able to collect and verify the required payer and payee information and transfer it to other businesses along the value transfer chain. And for proliferation financing, any RegTech who provides customer risk tools or transaction monitoring solutions should consider whether their solution is able to monitor for proliferation financing related transactions and indicators. On the topic of customer due diligence, any RegTech that provides CDD services should ensure that their solution will align with the new customer due diligence requirements and whether their solution is able to complete initial CDD quickly and efficiently, as this must happen prior to customer onboarding. And finally, for personnel due diligence, be prepared to provide information to assist REs in confirming that any of your staff who undertake work related to their AML CTF functions do have the skills, knowledge, and expertise required. So with that, I'll now hand back to Hilary and she'll take us through AUSTRAC's expectations and what you can do now to prepare.
Thanks, Isabella. Now, our CEO has said publicly that we do not expect perfection on day one. However, we do expect reporting entities to maintain their focus on reducing their risks. So for businesses that are currently regulated, AUSTRAC expects them to continue to implement their current MLTF controls. We want them to develop and document implementation plans that manage their risks while they transition their policies, procedures, and systems to meet the obligations under the reformed legislation. We also expect businesses to show sustained effort and progress against their implementation plans. We want them to continue to manage their MLTF risks through the changes, including implementing any tactical improvements in the short term. And finally, we expect businesses to act now to review and strengthen their existing frameworks, systems, and processes for managing their risks. RegTech can play a role here. We would love to see RegTech providers assisting current reporting entities in putting implementation plans in place. You can do this by engaging with your clients about updates that you might need to make to your solutions and the timing of when these might be rolled out. You also play a really critical role in continuing to assist them with their risk controls and management as they go through these changes. As an agency, we are keen to make sure we are educating industry and providing the right guidance so businesses like yourselves that support our reporting entities are prepared and ready to navigate the reforms, and you have the information you need to update your solutions accordingly. We do encourage you to get familiar with the nuances of the new and updated obligations, and we urge you to begin acting as soon as possible, as reporting entities will be looking to you to help them navigate the changes. Now, our CEO has spoken to the RegTech sector recently about reporting entities viewing RegTech as a silver bullet. Now, we definitely appreciate the value that RegTech solutions provide in the fight against financial crime, but we've also seen some compliance issues involving the use of RegTech solutions. For instance, when businesses set up a system that's not appropriately tuned into that business's specific risks or the types of suspicious behaviour that we expect to see. Unfortunately, sometimes reporting entities invest in a great system and improve their technology, but they don't bother changing management practices or implementing proper oversight over those technologies, So, for example, embedding oversight in areas where human discretion or human fallibility might come into play. So it's really important to be very clear with your clients that tech systems are only ever a part of the solution, and that management responsibility, board oversight, and understanding and responding to risk appropriately is what we are looking for. Now, AUSTRAC will continue to engage with the RegTech sector as we progress through the reforms. Our team offers AUSTRAC RegTech engagement sessions, which are designed to give RegTech an opportunity to engage with AUSTRAC to discuss or demonstrate your solution and ask questions to further your understanding of the AML CTF legislation in Australia. I will call out that they're not an opportunity to market a product or gain endorsement from AUSTRAC, as that's not something we can provide as a government agency. But to finish up today, I'll outline some steps that you can take now to prepare for the reforms. So firstly, we strongly encourage you to review the AML CTF bill and rules if you haven't already. The rules were finalised last month, and they do provide detailed obligations for businesses with a lot of the information you need to begin amending your solutions. Secondly, we want to see you engaging with AUSTRAC, specifically the education and guidance that will be released in the lead up to the reforms. The core guidance will be helpful to you and will provide practical examples of how businesses can comply with the legislation, as well as clarifying AUSTRAC's expectations. Regarding the travel rule, we'll also be holding a workshop on the new requirements, which we welcome RegTech to be a part of. Now, if this is something that you'd like to be involved in, we have an email address on this slide, which you can use to get in touch with us. And lastly, the best way to keep across the new laws or guidance or any engagement opportunities coming up is to subscribe to receive updates on the reform page and to subscribe to our quarterly newsletter in brief.
Thank you, Hilary. Yeah, this was a really valuable session. I will go through all of your questions and try and compile a list and maybe send it over to Hilary and Isabel to get some answers for you if I missed something. Maybe give us a few days to get that done. Otherwise, thank you all for attending, and thank you, Hilary and Isabella, for your expertise and your presentation. Did you guys have any final parting advice, words of wisdom?
Oh, look, words of wisdom I'm probably lean on, but my best advice would be to engage as heavily as you can in what's coming out and what is already available. There is a wealth of guidance and education that's coming your way. So really, really get involved and make sure that you understand what the changes are so that you can be sort of one of those effective RegTechs right up the front, ready to help reporting entities.
Sounds good. And at the RTA, we have obviously having a lot of conversations with many of our members about this particular topic. So there will be a lot of information from us in our newsletter in the future, and probably some more sessions as well for various different affected industries. I'm going to put a poll up on the screen. I'd really appreciate if you could just take 2 seconds to hit a number there. But thank you both, Hilary and Isabella, for your time today. AUSTRAC has always been a great supporter and friend of the RTA, and we are grateful that you consistently take the time to engage with our community. And thank you, everyone who has attended. We hope this session was valuable. Please do reach out to me if you have any feedback on this event, or if you would like to collaborate on another event in the future. Stay tuned for the post-event email tomorrow. That will have the recording and the links to some of our upcoming events. Yeah, thanks again. Take care, and we will see you online again soon.